You know what's crazy? In the richest country on earth, 3 out of 4 Americans will never see a $100,000 net worth in their lifetime. Not in the bank, not in investments, not in home equity. After decades of working, they still net out close to zero. And I'm not talking about people who never had a chance. I'm talking about people earning $70,000 to $100,000 a year with college degrees, full-time jobs, health insurance, and a LinkedIn profile that looks successful by every normal standard. From the outside, they look stable. A nice apartment in a decent neighborhood, a recent model car in the parking lot, the latest iPhone in their hand, and weekends filled with Amazon deliveries, brunch, and streaming subscriptions. But if you strip away the image and actually add up the numbers, their net worth is basically zero or even negative once you include credit cards, auto loans, student debt, and buy now, pay later balances. They're running hard just to stand still in an economy built on easy credit, monthly payments, and lifestyle upgrades that silently eat every raise before it ever has a chance to build wealth. In this video, I'm going to break down the hidden traps built into American money culture that keep people stuck in that cycle, even when they earn what looks like good money. More importantly, I'll walk you through a practical, numbers-driven system to get you to your first $100,000 in net worth faster than you think is possible if you're willing to ignore the noise and follow the math. Let's start with a hard reality check, because the numbers in the U.S. are brutally clear. For most Americans under 35, typical net worth is only in the tens of thousands, not hundreds of thousands, even after a decade of working. By mid-career, the median net worth does climb, but nowhere near what people imagine when they picture a comfortable middle-class life in an advanced economy. In other words, the gap between what Americans think they're building and what they're actually building is huge. On paper, a salary of $70,000 to $100,000 a year sounds like a ticket to security. You've got the degree, the full-time job, maybe benefits, maybe even a 401k match. In day-to-day life, it looks even better. A decent apartment, a financed car in the driveway, the latest phone in the hand, and weekends filled with Amazon deliveries, brunch, and streaming subscriptions. But behind that image, the balance sheet often tells a different story. High-interest credit card balances, auto loans structured over 5 or 6 years, maybe student loans, maybe buy now, pay later plans, and very little in real assets. After you net out the debts, the true net worth rounds to almost zero. This is not just about individual discipline, it's about a money culture built around monthly payments, lifestyle inflation, and the constant pressure to upgrade as income rises. In this video, we're going to dissect those structural traps one by one and show how they quietly keep even high earners stuck in that cycle, even when they earn what looks like good money. More importantly, I'll walk you through a practical, numbers-driven system to get you to your first $100,000 in net worth faster than you think is possible, if you're willing to ignore the noise and follow the math. Let's start with a hard reality check, because the numbers in the U.S. are brutally clear. For most Americans under 35, typical net worth is only in the tens of thousands, not hundreds of thousands, even after a decade of working. By mid-career, the median net worth does climb, but nowhere near what people imagine when they picture a comfortable middle-class life in an advanced economy. In other words, the gap between what Americans think they're building and what they're actually building is huge. On paper, a salary of $70,000 to $100,000 a year sounds like a ticket to security. You've got the degree, the full-time job, maybe benefits, maybe even a 401k match. In day-to-day life, it looks even better. A decent apartment, a financed car in the driveway, the latest phone in the hand, and weekends filled with Amazon deliveries, brunch, and streaming subscriptions. But behind that image, the balance sheet often tells a different story. High-interest credit card balances, auto loans structured over 5 or 6 years, maybe student loans, maybe buy now, pay later plans, and very little in real assets. After you net out the debts, the true net worth rounds to almost zero. This is not just about individual discipline, it's about a money culture built around monthly payments, lifestyle inflation, and the constant pressure to upgrade as income rises. In this video, we're going to dissect those structural traps one by one and show how they quietly keep even high earners stuck in that cycle, even when they earn what looks like good money.
More importantly, I'll walk you through a practical, numbers-driven system to get you to your first $100,000 in net worth faster than you think is possible if you're willing to ignore the noise and follow the math. Let's talk about one of the biggest reasons people stay stuck financially, not just low income, but how they invest, or more accurately, how they fail to invest in a way the math can actually work. The first mistake is believing you can save your way to wealth. People park money in savings accounts or CDs, earning a few percent, while the stock market over long periods has delivered average returns around 8 to 10% per year before inflation. Mathematically, that means they're voluntarily choosing a much slower growth path than someone who consistently buys broad, low-cost index funds, tracking markets like the S&P 500. The second mistake is starting to invest too late, after they feel settled, after the debt is gone, or after they hit some arbitrary income level. A 10-year delay can be the difference between having over $100,000 by your late 30s or having roughly half of that, even if you contribute the same amount each month. Many Americans say, "I'll start when I'm making more," but in reality, spending always grows first, investing always gets postponed, and the most powerful ingredient in investing, time for compounding, is wasted. The third mistake is emotional investing, buying and selling based on headlines, fear, and hype, or trying to time the market instead of staying in the market. They panic sell after a drop, lock in losses, then miss the strong rebound periods that often follow, severely damaging long-term returns. The result is a portfolio that performs much worse than a simple, boring, automated strategy of regularly buying a broad, low-cost index fund and leaving it alone. Finally, a lot of Americans treat investing like a short-term gamble, not a long-term system. They put too much into a few hot stocks, a random social media tip, or a get-rich-quick play, instead of building a diversified, low-cost, goal-driven portfolio aimed at hitting milestones like the first $100,000 over 10 to 15 years. In the next part, we shift from those mistakes to a concrete strategy, how a normal American with a normal paycheck and a busy life can build an almost automatic investing system that pulls them across that 100K net worth line faster than they think is possible. To build a genuinely effective investing strategy in the U.S., you need a system, not just a few good picks. That system has to answer three questions: what you invest in, how much you invest, and by what mechanism you make sure you keep doing it long enough for compounding to work. For most Americans, the safest and most effective core is broad, low-cost index funds, like total U.S. stock market or S&P 500 index funds, rather than trying to pick individual stocks or chase hot themes. Historically, U.S. equities have delivered averages around 8 to 10% per year on average over long periods, while most individual investors who stock pick and trade frequently underperform these averages after fees and emotional mistakes. A simple but powerful structure is the core satellite approach: 70 to 90% of your portfolio in broad market index funds as the core, and 10 to 30% in satellites that express your specific views, like tech, REITs, or small caps, still through diversified ETFs. That way, you capture the general growth of the U.S. economy while giving yourself a small sandbox for personal conviction without risking your entire plan. Automating the process, putting money on autopilot. Even the best strategy fails if you don't actually execute it consistently, so automation is non-negotiable. In the U.S., that usually starts directly on the paycheck. Use automatic contributions to a 401k, at least up to the full employer match. That's instant risk-free return. Set up automatic transfers from your checking account to an IRA or brokerage account every month. Then auto-invest those contributions into your chosen index funds. This is dollar-cost averaging, putting the same amount into the market every month regardless of whether prices are up or down. It doesn't guarantee the absolute best possible return, but it dramatically improves your behavior. You keep investing through volatility, and compounding keeps working uninterrupted, instead of being turned on and off by emotions. Setting clear contribution rates and targets. To reach your $100,000, vague intentions won't work. You need real numbers. A practical benchmark for many U.S. households is to aim for at least 15 to 25% of gross income going into retirement and long-term investing, 401k, IRAs, taxable brokerage accounts. If you're currently at 5 to 10%, increase your contribution rate by 1 or 2 percentage points each time you get a raise instead of upgrading your lifestyle. For example, someone earning $70,000 a year, investing $1,000 per month, around 17% of gross income, into index funds at an 8% average return can mathematically reach around $100,000 in under 7 to 8 years, depending on starting point and adjustments. The key is to lock in that monthly number early and let time amplify it. Staying disciplined when markets move. Any strategy gets stress-tested during recessions and crashes. A successful strategy needs behavioral rules. Maintain a separate emergency fund so you don't have to sell investments at the bottom to cover unexpected bills. Commit to not.
To truly harness compound interest in the U.S., you need to structure your entire financial system around 3 levers: time, contribution rate, and the environment your money grows in. That's how compounding becomes the primary engine of your net worth, not just a nice idea. Start as early as possible. Time is the biggest lever. Compounding works best when it has many cycles to work through. With the same return and contribution pattern, the person who starts 10 years earlier can end up with about twice the money by retirement compared to someone who delayed, simply because their dollars had more time to earn returns on returns. That means even if you're still paying student loans or not earning much yet, starting with small contributions, $100 to $200 a month into a broad index fund, is far better than waiting for the perfect moment. Contribute regularly and automatically. Real-world DCA. Compounding needs fuel. That fuel is consistent contributions into growth assets. In the U.S., the most effective way to make this happen is set 401k deferrals directly from your paycheck, at least to capture the full employer match. Set up automatic monthly transfers to an IRA or brokerage account and auto-invest into low-cost index funds using dollar-cost averaging so you buy through both good and bad markets. Dollar-cost averaging doesn't always maximize returns in a textbook sense, but it tends to maximize consistency. You invest through fear and euphoria, which is exactly what compounding needs: uninterrupted time in the market. Keep costs low and optimize the tax environment. Every 1% in annual fees is a permanent drag on compounding over decades. A portfolio of low-cost index funds with expense ratios in the 0.03 to 0.10% range typically outperforms high-fee active strategies over 20-30 years, all else equal. At the same time, qualified U.S. accounts like 401ks, Roth IRAs, and traditional IRAs allow your money to grow with tax deferral or tax-free withdrawals, meaning more of each year's return gets reinvested instead of paid out as tax. In practice, maximizing compounding in the U.S. often means prioritize 401k up to the match, then Roth/traditional IRA, then taxable accounts. That way, most of your compounding happens inside tax-advantaged greenhouses where growth isn't being pruned by yearly taxes. Don't interrupt the process. Stop digging up the roots. Compounding requires continuity. Every time you panic sell, pause investing for years, or constantly overhaul your portfolio, you're cutting the compounding cycle and effectively starting over. To avoid that, keep a dedicated emergency fund so you don't have to tap investments for every unexpected expense. Treat your long-term investments as untouchable money for at least 5 to 10 years. Accept short-term volatility as the price of long-term growth and stay focused on your time horizon instead of daily headlines. If you combine early start, automatic and consistent contributions, low-cost vehicles in tax-efficient accounts, and minimal emotional interference, compound interest gradually becomes the main force driving your net worth higher, especially after you cross that first $100,000. Diversifying your portfolio in the U.S. economy. Diversification is how you avoid betting your future on a single asset, sector, or storyline, and in the U.S. environment of boom and bust cycles, it's one of the key strategies for growing net worth steadily without getting wiped out by every shock. The goal isn't to eliminate all risk, it's to build a portfolio where one part can struggle while others hold up or grow. Diversifying across asset classes. For a typical American investor, a sensible portfolio often revolves around three major asset classes: equities, stocks, the main growth engine, especially U.S. stocks through broad index funds like Total U.S. Stock Market or S&P 500 funds; bonds, providing income and stability, helping to cushion the impact when stocks fall sharply; and real estate investment trusts, REITs, offering exposure to real estate income and price movements without having to buy and manage properties directly. A simple three-fund style portfolio might look like 50% U.S. stock index fund, 35% total bond market fund, and 15% REIT fund, giving you growth, stability, and real estate-linked income in a structure that is easy to manage and rebalance. Diversifying within each asset class. It's not enough to say, I have stocks and bonds. You need diversification inside those categories. For stocks, that means owning funds that spread across many sectors: technology, healthcare, financials, consumer, energy, industrials, rather than a handful of individual companies. Optionally, adding some international exposure if you want to avoid being 100% tied to the U.S. economy, although many U.S. investors still choose to overweight domestic stocks due to market depth and global reach of U.S. firms. For bonds, a total bond market fund provides exposure to U.S. Treasuries, investment-grade corporate bonds, and some mortgage-backed securities, giving you a mix of safety and yield rather than relying on a single issuer or type. Allocating based on age and risk tolerance. Your mix of stocks, bonds, and REITs should reflect your age, goals, and risk tolerance. A classic framework is some variant of the 60-40 portfolio, 60% stocks, 40% bonds, to balance growth with stability. Younger investors with stable incomes and long horizons, 15 to 20 plus years, often tilt more heavily towards stocks, 70 to 90%, to maximize long-term growth, while older or more risk-averse investors may hold more bonds and cash. The right allocation is one you can stick with during a 20 to 30% drawdown in stocks without panicking and selling at the bottom. A theoretically optimal portfolio that you abandon in a crisis is worse than a slightly more conservative one you can actually maintain. Rebalancing to maintain your risk level. Diversification is not a one-time action, it's an ongoing process. As markets move, your original allocation drifts. Stocks may rally and become an outsized share, or bonds might grow relatively when stocks fall. Rebalancing means periodically, say once a year, selling a bit of what has grown beyond target and buying more of what has fallen behind to restore your intended mix. Over time, a diversified, regularly rebalanced portfolio is far better positioned to carry you through multiple economic cycles while still compounding your net worth. A 30, 60, 90-day action plan. This section is your practical playbook for the first 90 days, how to move from paycheck to paycheck to a basic emergency buffer and an automatic investing system in the real world of U.S. living costs. Days 0 to 30. See your money clearly. In the first 30 days, the goal isn't to get rich, it's to understand exactly where your money is going. Track every expense: rent or mortgage, utilities, insurance, debt payments, groceries, gas, subscriptions,
Amazon orders, and those "I deserve this" moments after a long day. Once you have a clear picture, cut 3 to 5 low-value expenses, maybe too many streaming services, frequent takeout, impulse shopping. The cash you free up becomes the seed for your emergency fund and early investments. Days 30 to 60. Stabilize the foundation. From day 30 to day 60, focus on 2 priorities: tackling high-interest debt and building at least 1 month of essential expenses in a starter emergency fund. If you have credit card balances or personal loans with interest above 20 to 25%, common in the U.S., use the avalanche method, highest interest first, or snowball method, smallest balance first, to pay them down aggressively. In parallel, direct the money freed from cut expenses into a separate savings account reserved for emergencies only until you reach that first month of essentials saved. Days 60 to 90. Switch on the wealth autopilot. From day 60 to day 90, with some control over debt and a small buffer in place, it's time to flip on your wealth-building systems. Set your 401k contribution to at least capture the full employer match. This is guaranteed return that many Americans never take advantage of. Then, set up an automatic monthly transfer, starting with even $100 to $300 into an IRA or brokerage account, and auto-invest it into low-cost index funds using dollar-cost averaging so you buy through both good and bad markets. At the end of 90 days, you won't be rich yet, but the architecture of your finances will look completely different. Intentional spending, shrinking toxic debt, a growing emergency buffer, and most importantly, an automatic investing pipeline. From here, your job is to increase contributions as income rises and stay consistent so time and compounding do the heavy lifting in the years ahead. Personal financial insurance. Protect